Hey everyone, I'm Clayton Roche. I'm the head of DeFi with Mosendo, and I'm joined here with Tom Howard, who is the CSO of Mosendo.
Hey everyone, how you doing?
And we're here with Hugh Karp, who is the founder of Nexus Mutual. Thanks for joining us, Hugh.
No, great to be here. Thanks, guys.
Yeah. So maybe you could just give us a little overview. I understand that Nexus Mutual is insurance. So maybe you could just give people kind of a little overview so they can understand what it's all about.
Yeah, sure. It's actually an alternative to insurance. So we're not legally insurance, but the concept is the same. Basically, it just goes back to the original roots of insurance, where people just used to, as a community, pool their funds together and protect each other as a society, and do that in like a mutual or a cooperative type of way. And our big premise is the fact that blockchain is basically really good at financially coordinating a group of people. And that's essentially how insurance started, communities just grouping together. And so we're basically using that technology to enable kind of people to do it themselves in a like DAO-like structure. And so that's really what it's about. And so I guess we're targeting kind of rebuilding the old kind of mutual model of insurance in a kind of scalable way. That's our big aim. But we're starting with crypto native risks because they're going to be the first people to use this stuff. So we wanted a product that that they wanted to use. And so our first product is smart contract cover. And the main aim of that is to protect against bugs or hacks in smart contracts running on Ethereum. So, kind of the big obvious examples of things that would protect against are things like the DAO hack, or the parity multi-sig wallet issues, or other things that have happened where the smart contracts did something different to what they were designed to do, and people lost funds. So it's all about giving people comfort that when they interact with smart contracts on Ethereum, and specifically DeFi, because that seems to be where a lot of usage is happening right now, but it's to give them confidence that if something does go wrong, they're protected.
I see. And so from the perspective of people who are currently using DeFi, for instance, I'm lending a certain amount of DAI on Fulcrum. Is that the kind of thing that you would be able to offer protection if I were to engage with Nexus Mutual somehow?
Yeah, exactly right. So basically you can put your money in Fulcrum, whether that's DAI or Ether, and then you can buy cover on Nexus. And so I haven't checked the rates on Fulcrum exactly, but if you were to do something similar for Compound, then the rates would be about 1.3% per annum. So say you're earning 10% on Compound, take away 1.3 for cover on Nexus, and you're still kind of well ahead, and you're perhaps in a better position mentally and more comfort wise if something was to go wrong. So that's a big idea, but also it's perhaps more wide than that, because we can cover any smart contract on Ethereum that's been verified on Etherscan. So the DeFi stuff's kind of the obvious use case, but there are a lot of others out there.
Sure. Yeah, and that use case, I think, is just particularly interesting for our users, people in DeFi Nation, because lending is quite popular. I'm sort of curious though, so you're taking a small percentage of the interest earned on these principals, but it doesn't seem like that would be enough money to cover, for instance, let's say with Compound, for example. So I'm just kind of curious if this is one of those things where over time you accumulate kind of more and more protection, or how that might work if, let's say, there was a bug in Compound. And that would be potentially a lot of fun.
Yeah. So basically what happens is the mutual, the DAO, actually, we went through an initial kind of fundraising stage. So we raised an initial amount of money into the mutual from members contributing funds, and before we could start selling cover. And then what we do, so we initially kind of pre-fund the thing, so that if we do suffer early claims, then we've got enough money to pay out. And one thing we make sure we do is we cap the amount of cover that we sell on any particular system to 20% of the capital that we have. So that gives us a very high degree of confidence, unless there's like 10 systems go down at once or something like that, that we'll have enough money to pay the claims. And so then what happens over time is we write we write covers across a diversified group of different systems, that's kind of what insurance is all about, diversifying risk or sharing risk. And then we'll get enough income to kind of make it work on an ongoing basis.
I see. And so I'm curious then, let's say I were to get the coverage for compound. There's also some risk with DI, but I'm assuming it's not automatically covering both. It would only cover the contract with compound if there was some failure in the price of DI that wouldn't relate. Is that right?
Yeah, that's correct. So this is where it kind of gets a bit. There's contracts on top of contracts on top of contracts, and so you have to be a bit clever about what risk you're covering and understand what there is. And we're planning on putting out a few articles and kind of explainers about kind of how it works and what you should do. But for example, if you wanted kind of complete coverage, then say you're putting DI into compound, then you might want to buy some ether-based cover on Maker. Because if DI fails, it's maybe because Maker's contracts got hacked and the ether got stolen, and then also buy some cover, a DI-based cover on compound. So that would be a more complete coverage set. But yeah, like you have to understand where the risks are and what you're covered for and stuff, which is challenging for new users. And yeah, we're hoping to educate them as well.
Sure.
So in the example of compound, what exactly does the Nexus coverage cover? Like, what are the situations in which someone might receive get paid back for the risk that their capital has been put through, and then how is that determined? Like, what's the decision process there?
Yeah, sure. So what we like to, when interacting with smart contracts, we like to frame it in there's 3 different types of risks. And a Nexus at the moment we cover one type of risk there. So the first risk is the technical risk of the smart contracts failing or them not working as intended. And that's the risk that smart contract cover handles. The second risk would be like centralized aspects or outside the system aspects. So something like oracles or governance processes or admin rights or something like that. So a malicious actor attacks the system from outside, the code still works. So as an example, like Nexus doesn't cover that. And for example, in compound, they obviously have admin rights and they could change things and upgrade the system. A lot of these projects are planning to move to DAO-like structures in the future to reduce that risk. But right now they're kind of controlled centrally in some ways. So yeah, we don't cover that risk. And the other risk is the kind of like economic incentive structures if they were to fail. So in something like compound, if the economic incentives fail, then the worst case is likely that you're not going to get your money back. Like, your funds aren't lost, but they're locked. In the system, a lender may not be able to get the funds out because of liquidity issues. So I guess in compound, as an example, you are susceptible to the technical risk, the admin risk, and less so on the economic incentive risk. With something like Maker, there's obviously economic incentive risk as well, but there's less centralized aspects, you could argue. I guess as a kind of counterexample, like with Uniswap, we'd argue that there's there's no centralized admin external risk because there's nothing that it looks at outside the system, and there is very little economic incentive risk as well because you can't lose your funds if the economic incentives fail. So basically, in Uniswap's example, then there's only the technical risk, and so we'd encourage projects wherever possible to kind of remove or reduce those other 2 risks as well. Anyway, that was a bit of a long-winded answer, but I guess the second part of it was how the claims decided, and essentially that's a voting process conducted by our members. So that allows one reason we can't do that programmatically is what we're actually trying to do is work out what the intentions of code are, and so that's quite challenging to do, and so you kind of need to put humans in the process there, and we think that's valuable. it is going to mean that could be grey cases in the future, but we believe that's a better solution than trying to programmatically define what events are covered and what aren't covered. And we have a staking process there to kind of align incentives on the claims voting.
Now, is that similar to like a Claros dispute resolution model?
I haven't looked into Claros in a lot of detail, but I think it does have some similarities. And there's a kind of, we have an optional, like as a member of Nexus, you can optionally decide to get involved in the claims assessment. And then if that doesn't come to a kind of supermajority type decision resolution, then it gets escalated to all members who can vote without getting involved in staking.
Okay, and what is the current kind of benefits you could receive if you wanted to be a member of the mutual and maybe help decide claims or otherwise stake collateral?
Yeah, so you can get involved in the mutual in various ways. So you can do any or all of these things. So you can participate by just buying cover. And then you're still a member and you obviously get coverage. You can also stake. You can stake for two reasons. You can stake for risk assessment, which is basically putting your money behind a specific smart contract system that you think is secure. And when you do that, it lowers the price of cover for others. And if there's a claim, then you can lose some of your stake. And when others buy cover, then you can earn rewards for kind of encouraging people to buy it. So it's kind of like a prediction market system in some ways. It has some similar elements. And then there's the claims assessment process, which you can earn a share of the claims assessment fees as rewards. And then there's also governance. But in general, all of the cover is priced to expect to leave a surplus in the mutual, which is kind of shared amongst all the mutual members. And so that's the kind of crux of the mutual. Like everyone in the mutual is sharing risk amongst each other. And to the extent that there's money left over after claims have been paid, which we expect there to be, then that's shared amongst the members as well. So it all stays in the same pool.
So it sounds, if I understand correctly, you're spreading out the risk among all the members. So if one of these smart contracts fails, it would hit everyone equally. Is that right?
Yeah, that's right. It hits the pool of funds, yes.
Okay. But then you also said that you, as a person providing funds, you could choose which contract you wanted to insure. Is that right?
Yeah. So basically, what happens is, as just a general member that hasn't staked for risk assessment, then you're sharing in the diversified risk of the entire pool.
Okay.
And then additionally, you can choose to kind of double down your risk. So you can, on a specific system, you can kind of double down and then earn additional rewards if you wish. And so that's entirely optional.
Okay. And a question that I had for you, and I think you've already basically answered it, is, so you mentioned that it was 1% and some basis points for compound. And so I was curious, like, how you've determined that level of risk, but it sounds like that's based on how many people are willing to put their money there. And so it's a market determined percentage. Is that the right way to think about it?
Yeah, so it's mostly market. There's balance. There's two elements to it. We have an algorithm which tries to approximate how battle tested a contract is, like how long has it been on mainnet, how much funds has it held, how many transactions, etc. And the price comes slowly down over time. So if there's no staking, when a new contract's deployed, we can't offer cover. Because essentially it could be a malicious contract as an example, right? And so then what happens is we enhance that kind of base algorithm, which is a very conservative kind of algorithm, to then with the staking. So when more and more people stake, it drops the price. So it's kind of like, if you think of it in some ways like a more structured prediction market for a specific use case that has some bounds on it about how it actually works. And then it has a minimum price when basically compound is at the minimum price because lots of people are staking on it.
I see. And do you take into, so it sounds like it's a mix of market forces, but also just qualitative criteria, or I mean, they're quantitative, but they're also sort of evaluated on a qualitative level. I'm curious if audits are a part of that at all. smart contract?
No, we didn't. So what we tried to set the base algorithm as just using like on-chain data, or externally available data, and then what we do is we kind of allow anyone to stake on any basis that they see fit, and so that they can use tools, Mythex or other, automated tools to assess smart contract risk, audits, whatever they want to do. They could, look at the code themselves or gamble if they wish. That's entirely up to them. And so we kind of want to stay agnostic to actually how you come to that, because it's obviously a developing area and more tools and better stuff's coming out. So we want to stay agnostic to that.
So you let the stakers make a decision if the project is posting these audits and they agree with them, and they're more likely to stake.
Yeah, exactly. So we just follow the money, and more money will come from where better tools and systems are used. That's the idea.
So as long as you're staking like that, capital is at risk. In the case of any sort of event that requires coverage to be paid out, right? What happens if, say, Compound gets hacked, but stakers withdraw their capital before that kind of like gets logged into the Nexus Mutual system?
Yeah, so stakes are locked for 250 days and they're linearly released over 250 days. So yeah, so you can't just take your money out to prevent the burn if there's a claim event. Yeah.
So there's basically like a claim window, in a sense.
No, so what happens is if the price of risk at any point is based on how much staking's there, and then the staking gets released over 250 days, which kind of and you've also got the battle tested algorithm kind of also reducing price over the same rough period. So it kind of works. And so what happens is if you've staked and you've earned your commissions, and then there's no contract bug over 250 days, then you get your stake back and you can restake.
What are the fees looking like right now? You mentioned there's like a minimum fee and Compound's at the minimum. What does it look like across the ecosystem right now?
Yeah, so mainly, to be honest, most of the cover that we've sold has been on the DeFi stuff, which has tended to be heavily staked. So most of it is actually at the minimum, but there are other ones that have been bought at higher rates. But from ranging up to about 5 or 6% per annum. But most of the stuff is being sold on the big DeFi stuff like DYDX, Nuo, Compound, Maker.
Sure.
Right now.
And
So what was the minimum?
The minimum is 1.3% per annum.
1.3%. And so if I were to buy insurance or whatever you call it in cover in Compound, do I have to have capital in Compound, or do I just say like I want this much? I want like $100,000 covered.
We don't check whether you've got cover or not. So in theory, you could use it as a shorting thing on Compound. But
if I were a hacker and I discovered an exploit in Compound, then I would go open up a ton of cover, as maximum amount of cover in Nexus before draining Compound.
Yeah, there's also 100 million sitting in Compound. So if you found a bug, you probably take that first. But yes, but that is true. I think that we don't check. So, like for example, if you've put like 10,000 in Compound and you're comfortable losing 1,000 of that, you can buy 9,000 of cover as an example, right? So right. That's up to you.
Okay, that's interesting.
So I'm curious about the benefits. So we've talked about that you can stake a certain amount of tokens into the system to buy the coverage. Oh, but you can also provide the capital that funds the mutual. And I believe you were saying that you would. No, actually, I'm not sure now. When you're providing capital, what asset are you providing?
So if you just want to provide capital, you provide Ether to the pool. You can buy cover in either Ether or DAI-based cover.
So you're providing Ether, and what are the current Ether kind of returns that people are seeing for that service, providing that ether?
Well, we're kind of early right now, and so like insurance businesses work like long term, and there are two main sources of income. The first is obviously the surplus that gets left in the pool from cover, and so we haven't had the covers kind of expire too much yet, so you kind of haven't gone off risk for them yet. And so there's that, and then there's the kind of investment earnings of the assets, of the pool of assets, and that second one is actually a very underappreciated one, and probably amounts to like 50% or something of the returns. We actually haven't. Our system has enabled investment earnings of the assets of the DAO. We haven't like switched it on yet because we just want to test different parts of the system first. For example, the pool itself could actually stake money in some DeFi smart contracts. There's obviously a systemic risk there about how we do it and what we want to do, but it can like get involved in like staking in proof of stake when it becomes available and stuff like that. To be honest, we haven't. There aren't any solid numbers right now. Basically, people are getting involved right now on the anticipation that this thing will grow. And then as we write more and more cover, more and more surplus will get left in the pool.
Sure. And right now, there's not a lot of high competition for lending ETH. Like you can't really get very high returns, at least on decentralized platforms. So you don't need to be terribly competitive in terms of the returns to attract ETH.
Yeah, well, and that's true. Yeah, and I guess, and also ours is less of a. There's no defined return. It's a variable return.
Sure. Yeah, that's very interesting. Okay.
If the cover is being deposited in ETH, but it's covering CDI or something like that, how do you kind of price that in the case of a payout?
So basically, and this is part of the kind of, we have an automated investment module that makes sure that when we have enough assets in the right currencies to pay out, or it'll convert them through Uniswap if we don't in advance of a claim payment. So that's roughly how it works. So if you want to buy cover in DAI, so DAI-based cover, then you can actually contribute DAI to the pool. Mm-hmm. And could we have a bonding curve or a continuous token model sitting behind this thing? So what would actually happen in the background if you contributed DAI is it'd work out the exchange rate to Ether, work out how many tokens that counts, buy the tokens, and then destroy them to purchase cover. And you haven't really seen any of that. All you've seen is you've just put DAI into the mutual and got some cover. So and as part of that process, you've also got a small amount of NXM tokens.
Okay. So is that like similarly over collateralized like Maker is if it's part of the ETH?
Well, right now we're over collateralized, but that's not the intention at all. Insurance works because it under collateralizes everything. That's the whole point. If we were like a fully collateralized version is actually quite close to a prediction market. And the thing that insurance has, main benefit it has over prediction markets is the fact that it can write trillions of color on billions of capital. Like that's how insurance companies work. And so that's the whole point. We're sharing risk, and then you're making the assumption that all events don't happen at the same time.
Got it. So by limiting the maximum exposure of, say, like compound to 20%, then you're basically that pool is for all of the contracts, not just compound. Yeah,
exactly. So if we write, so you make sure that you don't go bust from one or two individual events.
Yeah.
But then you can write cover on, say, we can write cover on 100 systems, and they can all be below 20%, and so you're sharing. But the total amount of cover is well above what the total assets that you've got. So you're under collateralized.
So do you currently provide cover for the Maker contract?
Yep.
So if DAI is the kind of like the asset behind all of the other DeFi contracts, wouldn't that put your all of your contracts at risk if there was a maker failure?
Well, if maker fails, then Compound's contracts are still acting as intended. DAI may not have any value, but yeah. So yes, and that's where it comes back to the. That's one of the challenges about the education side of things, about what understanding the users actually understanding where the risks are. And I guess, yeah, and that is a challenge, especially when we're doing this money Lego stuff where, okay, what is actually connected to what and where are the risks? And that we acknowledge that that's a challenge. But hopefully in this world where everyone's building on top of each other, which is really, really cool and gives us some huge flexibility, and there's a massive benefit in my opinion, all of the risks kind of add together. And I guess what we're trying to do is provide one option to subtract some of those risks. So
that's interesting. How many smart contracts are you covering right now?
Different smart contracts are probably about 10, 15, something like that.
Have you ever had a claim?
No, we haven't had a claim yet. I'm looking forward to actually having a claim. So we not for the sake of people losing money, but for the sake of testing the system to demonstrate that it works. Yeah. Not yet. We've only been live for a couple of months. So.
Sure. What's the process for adding new contracts?
So adding new contracts. So basically, any smart contract verified on Etherscan can be covered. It's automatically covered. There's a process where we want to identify like the lead or the master contract of the system, so that people stake and buy cover on the same contract. So it kind of matches up. So we use ENS to kind of help coordinate the community, but in reality, you can get cover on any smart contract system, provided it's been verified and the code's open source.
Been verified by?
Oh, sorry, verified code on Etherscan, so we can see the code basically.
Yep. And is that an open system where basically anybody who wants to submit some cover to a contract just does it, and then somebody else can be the counterparty?
Yep.
Okay.
Yeah, exactly. Yeah.
So something, Hugh, that I liked about your white paper, you talked about kind of the old intention of a mutual and like community insurance, and typically it was people in a smaller community might pool some funds, and then you would just sort of decide as a community whether something needed to be reimbursed, which is only possible, like that's not scalable, of course, like it's really just possible on a village level. But what I like about what we have here is like an on-chain event would be a publicly verifiable event, like everyone has consensus about what happened. And then obviously if you've incentivized members correctly, they would want to behave consistently with the value of the platform, which is, as I understand, the way that it's intended to work, of course. So just personally from that idea of a mutual, it would fall under the category of informal finance, which is just basically any finance that doesn't fall under government remit. So I like this combination of the informal finance and the DeFi space that you've done here with Nexus Mutual, because I think it models what has existed kind of before the formal financial structures, and connects people, but it's also like a lot more scalable. So I see it as kind of a neat combination of those two spaces.
Yeah, no, thank you. Yeah, that's what we're aiming for. I mean, if you actually think about it, we've got the kind of insurance space has been dominated by shareholder-driven companies, mainly because for perfectly good reasons. Basically, because the mutual model it's hard to grow that, as you said. Like they struggle to grow that trust, and they also struggle to access capital, because usually they're just people in a village or whatever. They don't have massive deep pockets, and insurance tends to be capital intensive. So shareholder companies kind of came in, and because they were quite efficient at connecting the capital markets to the people, which is kind of what you need to do. And so that makes entire sense. But I guess our premise is we've got a new technology now that can connect people a lot more efficiently. and allow them to coordinate financially without knowing each other, because they kind of know the rules of the game. And as long as we design those rules of the game in the right way, then hopefully we can incentivize the right behaviors. And that's essentially what we're trying to do. So hopefully, I think the technology actually fits really naturally with with the goals of in mutuals and cooperative like structures like this.
Sure. That's great. So I had kind of one last question for you, which is maybe just on the personal side, like why, if you don't use the word insurance, but like why mutuals, or what kind of brought you to this idea, and what inspires you about providing coverage like this?
Yeah, I mean, I'm from the insurance industry. I've been doing insurance for quite a long time, and I guess I got the intentions of the industry are fantastic. You know, it's to protect people from bad events. You know, like we all kind of need that stuff, and the products aren't there. But there's this inherent conflict of interest between the shareholder and the customer, and I guess I got a bit jaded by just shifting numbers around on a big balance sheet to become more capital efficient and stuff, and it kind of the kind of true purpose of it gets a bit lost when you've been in the industry for a while. I mean, it's always there, but it does get a bit lost. So I think that's what I really liked about the old structures. They're really kind of community based and do it for the people, and the benefits go back to the members. And so there's and I think that if we can make that model work at scale, then it has a lot of benefits to just regular people.
Cool. I like that. Did you have anything else to ask?
No.
Cool.
It's a very cool model.
Yeah. Well, yeah, thanks for joining us. I know that people are really excited to test this out. Is there anything else that you think people should know before we sign off?
No, cool. I mean, just get involved. I mean, we've got a lot of docs on our website and stuff if you want to dive into the details. It is a relatively complex system. So yeah, ask questions in our Discord. Hopefully we can get back to you pretty quickly. But investigate the details first before getting involved, and come and chat to us if you need to.
Right on. That sounds great. And look forward to seeing what comes out of Nexus next. Thanks a lot for joining us.
Cool. Thanks. Great to be here.
Cheers.